Hello. Hi. Good evening, everyone. So before we start, as usual, we do a sound test first. Okay, audience, please give me a response if you can hear me. Test mic, test sound. 1, 2, 3. Hello, good evening. Hello, testing once again. All right. Thanks for the response from the audience. Right, okay. Good evening, traders and investors. Welcome to our Apex Derivative Trading Challenge webinar series. And I'm your host for tonight's sessions, Su Ling. So this is a special additional sessions we have prepared just for you. So how was your trading journey going so far? And feel free to share your thought and experience with us over at our Discord channel, the Trader Community, and we'd love to hear how things are going and help you to improve along the way. So for those just joining us, yes, the registration for Apex Derivative Trading Challenge is still open and it will remain open until 16th of June. So we have 6 more days for the registrations. So if you haven't registered yet and there's still a chance, don't miss this chance to take part and sharpen your trading skill and gain valuable experience. To participate, what you need to do is open a trading account with us is the first step, and fund your account with 100 ringgits of the registration fee. Enjoy the benefits such as access our trader community to interact with others and discuss the market. Also, you have a chance to get a 1 hour one-on-one coaching sessions if you need personalized guidance. So in our trader community, you can share the idea, discuss strategies with the fellow traders. If you're not ready to trade yet, don't worry. We have a recorded webinars and today's sessions available that cover the basics of futures trading, trading strategies, how to use the trading platform, and so on. So today's topic, right? Okay, learn when to trade and when to take profits without guessing by Mr. David Ng. He will be sharing the valuable insights on how mindsets play a critical role in trading success and what is really taken to build a sustainable career in trading. So make sure to take notes and feel free to ask questions later in the sessions. Alright, before we start, as usual, today's session is purely for educational purpose. There's no buying or selling advice, so please understand the risk involved and seek independent financial advisor for investment decisions. Now, let me introduce our speaker for tonight's sessions. So we are excited to have with us Mr. David to share with us again, and he's a seasonal full-time proprietary trader at Iceberg X Sdn Bhd, a local proprietary trading firm based in Kuala Lumpur. David brings a wealth of experience in trading commodities and indices. With a strong focus on the Malaysia Index and crude palm oil futures, he has a solid background in research and is known for his sharp market insights. So before his current role, David led a young and dynamic team at a prominent local brokerage, actively promoting the futures trading and derivative to Malaysians public. Many of you may also recognize him from his popular seminar and market coaching sessions, what he has helped countless individuals begin their trading journey. In addition to his on-the-ground trading experience, David is a regular contributor to The Star, Business Time, and The Edge, offering the market's commentary and insights. Academically, David holds a degree in economics and business study from the University of Manchester, and he's also a Chartered Market Technician, CMT, the title, a testament to his technical expertise. So without further ado, let's give a warm welcome to Mr. David Ng as he shares the practical trading strategy and discuss the topics today: when to trade and when to take profit without guessing. And what's with that, I will pass the mic over to Mr. David.
Yeah,
So let
thank
me
you,
stop.
Celine.
Yes,
Yeah, I'm just gonna have a quick check. Can you hear me?
yes, I can hear you.
Okay, I'm just gonna share my slide now. Just let me know if you can see my slides. In full screen.
Correct, in full screen. I can see the screen.
Okay, yeah. Okay. Thank you very much, Celine. So firstly, just like to thank Apex Futures for inviting me. To talk on today's topic. Entitled, trend on trap. Learn when to trade and when to take profit. And try to do this without any guesswork. And I think importantly, if you are new to the trading journey, I think it's important to make sure that you have a certain structure. So I've discussed in the past two webinar sessions on especially on looking at the Malaysia market. If you're trading a CPU and FKLI, that is obviously a mix of fundamentals and technicals, and how you interplay between these two factors. And in order, if you can combine these two practical factors, and how to create a practical trading plan accordingly. So I think today's topic, I'm just going to touch a little bit more besides looking at Bursa products. I'm also looking into other global products, especially on uh, other um, other market spaces, especially what's being offered on other exchanges like CME. So I think those products are also giving a lot of opportunity, given that the market is highly volatile and therefore that presents a lot of opportunity that's available for the audience to trade. So I think importantly is that we need to have a way and a structure for us to really navigate the market. Without that, I think if it's leave it to guesswork, usually your outcome will be very different, and eventually, when the outcome is different from expectation, that's where a lot of uh, beginners will tend to just give up. If trading is it failed to meet their respective expectations. So I think it's important for us to get that right. I think a lot of trading work is not a guesswork. Importantly, you must have a structure in place. So hopefully, in the next hour or so, I'm hopefully enable you to gain a better understanding on how to create a structure when it comes to revolving around your trades. And with that, I think it's important for us to navigate the market with certain strategies, and those strategies try to be a bit more applicable and practical in that sense. So as usual, I think just to put a risk disclaimer out, I think any material that's presented here today is purely for educational purpose. So just to reiterate what Sudan has mentioned, and I think important to take note as well is that any opinion that's reflected today, based on my presentation, is purely based on my personal opinion, doesn't reflect any opinions from whether it's from Apex or from the exchange. And importantly, the material that's presented here is not vetted by the regulators. So it's purely for education, and any you know positions or opinions or even views are purely based on personal basis. So if you are dabbling in futures market, to understand that it involves risk. If you are new, make sure you consult your licensed representative, and I believe Apex Futures will have tons of resources for you to kickstart your journey in trading futures market. So hopefully with that we will just get that through. Now I think in the next hour or so, I think this is what we're going to cover. I think mainly is how we're going to create, a trading plan accordingly. Now, since we are talking about global markets, I think it's importantly also to set a context right. If you have noticed that in the past first or second session I just covered earlier, you notice that in the beginning of the session we usually cover on things like market reviews on how the market is going, because that will create ultimately your views of the market. So if a market is doing very well, you should see prices tend to do, or the trend tends to be a bit more bullish. But when the markets are not doing well, that's where prices tend to be a more bearish pace. So it's important for us to understand the market tone, and how we do that is to really understand where the market is going or heading. And obviously, you can get all these resources, whether if you look at internet, there's plenty of resources, but make sure you have a way to filter it out. And once we understand the market tone, and then from then on, we are able to identify your trading plan accordingly, or create a trading plan accordingly. So, just also to disclaim, I think if you are looking at trend trading, whatever I presented here, the materials are purely based on trend trading. So if you are looking at something that's beyond trend or looking at something as more of a range trading, then I believe that trend trading may not be appropriate. So it's important also to understand when the market is trending and when the market is not trending. So when it comes to trend trading, it's important also to assess that when markets are trending, and that's where you should use specific trend trading strategies that's able to help you to navigate the market accordingly. So obviously, when the market is range, you have to change your plan accordingly because trend trading doesn't usually work when the market is ranging. So there's a couple of markets right now that you can see that the patterns are very clear. The markets are moving in a side range market. So during this time, it's important if you're using trend trading strategies. Sometimes you get a lot of false signals, and that's where you need to be careful and cautious about, and to look at an overall perspective of where the market is going or heading in the foreseeable future. I'm just going to touch a little bit on the technical tools I use whenever it comes to trend trading. So probably I've heard this in the past couple of sessions, but I just want to reiterate again and also to emphasize, these trend trading styles and strategies can also be applicable in other markets. It's not only restricted to Malaysia markets per se. You can also apply that in other markets as well. But obviously, there's certain nuances that you need to be aware of. If you are trading global markets, obviously there's a lot of factors that you need to consider. So you've been doing this for FCPO when you trade global markets or commodities in the global space like oil or even gold. There's certain dynamics that you need to be more careful of as well. But however, I think the principle of trend trading still remains. When the market trends, always work with the trend and not against the trend. So, example, if the market is in a bullish trend, always think of positions for it to long rather than short. If the market is on a bearish trend, always think of position to short rather than long. I think it's always common in human nature that you always try to time the reversal of the market. We always want to pick the top, you always want to pick the bottom. It's never easy to do that. So when the market trends, always be in a position that follows the major trend. Now, besides that, I also will touch on EMI, which is part of the trend indicator, and also ATR, which is also part of setting a target profit and stop loss accordingly. Because important, once you identify entries, you also need to identify where you should be stopped out in case the market will go against you. Now, keep in mind, market doesn't always work in favor. There's always be a time when market, sometimes the market will just work against your favor. So when during those situations or those periods, especially when markets are very volatile, you must have a way to make sure you get yourself out, be protected. I've seen a lot of cases. I've seen based on experience. I've seen many cases where, if a trader that's new to the market, they tend to be a bit more sloppy when it comes to managing their risk or loss position. And once they don't control that well, they let the loss position becomes bigger and bigger, and eventually that will wipe out the trader. So that's a very sad fact, but I think that's the nature of the market itself. So importantly, if you are new to the game, always make sure that you must have a way to manage your risk. If you don't have that in place, it is very dangerous not to be in a position without a proper risk management. And last but not least, I have always mentioned in the previous session talking about trading psychology, it's important to have a performance review. So you need to understand where you are heading, especially when it comes to market. If you are, if you don't have a performance statistics on your performance, that's like saying that you never know whether you're improving or you're not improving. And it's important for traders to always review him or herself, because without that, without proper review, without a proper snapshot of your performance, you never know how far you progress. So I'm just going to give you a brief market review. If you just look at year to date, some of the key major asset classes. So here we are talking about equities, commodities, not only talking about Bursa, FKI, and CPO, but you look at in general, in global context, you can see that a lot of commodities this year, whether you're talking about soybean or wheat or corn especially, has not been doing well. And in fact, CPO also has not been doing well. I think year to date we are down by almost 20%. Now there's a lot of factor to it. I've covered that in the first session. It's mainly down to supply and demand. So whenever you have big supply that's coming, on stream, like what we see today after the release of MPOV report, production month to month increased by 5%. Stock levels are almost 2 million. So all these factors are negative factors, and that eventually will tell why prices are coming down. So commodities, especially grains, palm oil, is actually weak. Now, you look at metals, precious metal like gold and silver, especially silver has gained a lot of traction in the past couple of days. You can see there's thematic here. So, gold is always asset class for safe haven. So when things are uncertain, people rush to gold. So we see that gold has actually rallied tremendously. So if you understand the market, if you're trying to short the gold market, it's never easy because the thematic theme is that people are going into gold market or precious metal space because people are thinking that uncertainty, with Trump, tariff and whatnot, is giving a lot of market uncertainty. So, if you are trading gold, if you are trying to find a short position, it's never easy because the market is still trading upwards. So that's important to understand the context. Now, equities as well, whether you're talking about S&P, Nasdaq, or even US, those tech stocks, they're still doing very well. In fact, even European stocks like DAX, they are not. I think year to date they're performing almost 20 to 25% upside. So you can see that generally the markets are a bit more favored towards equity, and as long as there's no major crisis in loom, or things are still going well on that per se. But having said that, whenever you see precious metal, like especially gold, keep rallying to new highs, and despite we seeing strong equity performance, normally it signals to you that despite what we are seeing in the equities market, something is not right, especially with the global economy. So it's against it's always a context where what happens in the main street and Wall Street is always different. So I think that's where we need to juggle our views are, and hopefully when you navigate, futures market, whether it's global or the local scene, it's important to have the context in place. But not fair enough to say, or pretty certain to say, that I think going into the second half of this year, especially now we're in second half, we're definitely going to experience more volatility ahead. So, as a trader, yeah, we like volatility, but we also make sure that we have a plan to make sure that we don't get ourselves short-handed whenever the position go against us. We must have a risk or way to manage the risk. So just to give you a global context, now clearly I think when we started off this year, before Trump came into the picture for the second time as the US president, I think things were looking well. But when Trump came in for the second time, Trump 2.0, that's where tariffs starts to kick in. And when that happens, you start to see wild movement, wild swings across major asset classes, whether it's equities, whether it's precious metal, whether it's commodities. So I think for the foreseeable future, the Trump tariff is going to be something that's uncertain, and it's going to be something that's variable that will change the dynamics of a lot of asset classes. So whether you're trading, commodities or indices, it's important to have that perspective in place. So if you are trading crude oil, for example, knowing that you're going into a volatile season, so don't keep your positions over the weekend. That's very crucial. In fact, if you are day trading crude oil, that's a good way to start off with, because the volatility can actually wipe you off quite fast. So global outlook doesn't look good in the second half of this year, mainly because of Trump tariff, the US tariff impact on China, and not only China, pretty much across the world. So you can see that I think things are slowing down a bit. People are more cautious. Businesses are slowing down because they are not sure where the tariff impact is going to hit them and how is it going to hit them. Or in fact, the magnitude is still quite uncertain. So with all this uncertainty, businesses are slowing down. Confidence are definitely going in downhill, and that's where we pretty much the global outlook is cautious in the second half. Now, talking about US, like I mentioned, it's always a debate between Main Street and Wall Street. There's always a discrepancy, the divergence between. So, Wall Street is very optimistic, but Main Street, however, is always very pessimistic. So, if you look at the stats, you can't run away from economic statistics. As long as you have high jobless claims and unemployments are slowly inching higher, these are not good telltale signs of the economy. Now, if you just look at where, like I mentioned, businesses are not feeling confident enough because the uncertainty in the tariff is creating a lot of chaos. And when businesses are not confident, they will not spend, they will not invest, and it's pretty much a cycle downhill. So this is where you get tricky. And if this confidence starts to diminish over time, it's really going to have an impact on the overall economy, especially on the US market. Now, if you just look at weeks, which is a barometer of risk, whenever weeks spike up, normally it tells you there's something happening. We've seen that back in April when US starts the Liberation Day, when tariff starts to hit everyone, all the markets will go crazy because for the first time, US is imposing heavy tariff on pretty much all the countries around the world. So I think that slowly, there's a truce, there's a 90 days truce, and I think that eventually brings the market back to a bit normalcy. But when you look at VIX index, although VIX index is low at the moment, every time when VIX index is low, it's like a spring coil. It can really spike up whenever there is a sense of where there's a or rather there's a momentous event that can really trigger a spike in the market. So be careful. I would say that despite the low risk reading that we have right now, which indicate the market is quite complacent. There's market in fact is not factoring big risk, but going forward, with such complacency is never good because whenever there's a risk, whether it's geopolitics, whether it's tariff impact, it could be anything. Eventually, the market will react. So, you come to a point where market is very complacent, and usually it's not a good thing. So, if you are trading equities, futures, or even commodities per se, be on the lookout because I think any news can really spike up certain asset classes. Now, US is definitely on feeling the impact. I think not only US, China is also feeling the heat. Certain statistics are showing you that PMI numbers are coming down, showing you which indicates the manufacturing pace is also coming down. And the funny thing is that despite the exports to China exports to the US has actually slumped because of the tariff. You can see that China exports to other regions are actually improving, especially the Southeast region, whether it's Malaysia, Indonesia, or Singapore. Those numbers are improving. So it's in a way, despite the headlines are telling you that China exports to the US is slumped because of the tariff. I think China is re-strategizing some of the exports to certain countries so that it's in a way is trying to divert some of the exports to certain Southeast Asian countries and re-export back to the US using other regions. So again, the net impact could be minimal, but I think US eventually will realize this and probably they will do something about it. But having said that, I think as what I mentioned earlier, whenever there's a trade or there's a tariff, impact coming on, both countries will not want it, and eventually, hopefully they could reach a deal in time to come, and that will give a bit of comfort to the market. But till then, I think markets are still very volatile. And if you are trading a market space, whichever asset classes you are trading, you have to be cautious of this impact. Now, if you are in precious metal, I think this is going to be a powerful year because you can see that gold is holding well above the 3,000 US dollar mark. So I think that's very once it's hold a solid footing, it's just telling you a signal that gold is actually quite bullish. Now, I don't go too much on what drives gold prices, but I think mainly again it's because of demand from central bank. So central bank is purchasing more and more each month, especially China central bank. It's just telling you that market is really driving on optimism, and as long as this bank buying is still quite persistent, there is still going to be more upside for gold. Now, I'm not going to go too much on this debate, but there's definitely debate going on where whether gold is the ultimate store of the currency. You can see that slowly there's less dominance or less reliance on US dollar as a currency reserve, and slowly a lot of central banks around the world are slowly moving their dependence away from the US dollar into gold. That explains why gold has actually been inching higher and higher. Now, if you have this perspective, if you are trading gold, if you are trying to time the reversal in the gold market or at least a retracement, it's not going to be easy as long as this central bank buying, purchasing is remain very resilient and strong despite the high prices. It's going to push gold prices even higher. So I think that's an area that we really need to be careful and aware of if you're trading the gold or precious metal space. So that's pretty much the context I'm going to paint to you. So you can see that going into the second half, you can expect more volatility, that's for sure. Secondly, I think if you are trading whether it's equities or precious metal or even in fact commodities like crude oil, you have to be very careful of tariff impact because all these tariff news is going to impact not only one asset classes. It's pretty much across the board. Then I think thirdly, precious metal space, precious metal as a whole, if in fact not only gold, you look at silver and even to a certain extent platinum, I think they are gaining traction. Whether some may argue it's industrial demand or whatnot, but I think because the sentiment is there, the hype is there, people start to watch the precious metal space, and because of that, the trend for most of the precious metal commodities are actually doing well. So again, going back to the same principle, if the trend is in favor, is bullish, work with the trend. So if it's a bullish trend, find positions too long rather than short. So going into the major bit, so once we understand the context of where the market is behaving or leaning to, then it's important for us to structure a plan for us to navigate the market accordingly. So now, as the title says, when to enter and when to exit is very crucial. You must have a plan that ensures you the way for you to enter and exit. If you without that, it's very difficult. And if you don't have a structure in place, it's very difficult for you to gauge whether whatever structure you have, or plan it out, whether that works or not. And again, I would just want to emphasize this point: market is very dynamic. It doesn't mean that you make using this structure you make good money. It will be forever making you money, because market dynamic can change. Market always evolve. So sometimes whatever structure you put in place, it may work for a certain season. Once the market goes to a different season, the structure will have to change to adapt to the market. So these are the things that you need to be aware of. And in other words, it's not saying that you must have a plan and you fix it accordingly. You have to be very variable. Once the market dynamics change, in a way you have to also adapt your trading strategy or trading style to the market. So I mentioned, I think the first key thing is to always identify your trading plan. And in regards to trend trading, it's always about trying to identify where the market is trending. Is it trending upwards, downwards? If it's sideways, then technically the market is going range. And if it's market is in range, trend trading usually may not give you that good results, because there's no trend that's in place. Market is just moving on a range basis. So that's where, if you're using range trading strategy, that will be a better fit for the market. So the key thing is always to make sure that you can identify the market trends, whether it's upwards or downwards or moving sideways. To do that, you can always use moving averages or looking at the chart visually. Now, I think if you have watched some of the webinars I conducted, I always emphasize looking at trends using candles itself. And the candles derivation here that I always like to share with the audience is to use the Heikin-Ashi candles, which is the type of candles that display to you the trend tendency in a much clearer picture. If you're using Japanese candlesticks, sometimes you don't see clear trends. There's always a red candle, green candle bar side by side, so you never know. Market could be just range. But if you use a Heikin-Ashi bar or Heikin-Ashi candles, then you can clearly see that actually the market is actually trending upwards. Despite maybe the uptrend is slowly showing a slight slowdown in momentum. So as long as it's still showing an uptrend, the market is still in the trend per se. So Heikin-Ashi, in that sense, the candles itself are more prominent when it comes to displaying to you the trend tendencies of the market. Now, besides just looking Heikin-Ashi, you can also incorporate moving averages. We're going to show you later on a couple of slides and different markets. If you incorporate moving averages with Heikin-Ashi, you pretty much can get a rough signal to enter and a rough signal to exit the market. Now, DMI, which is also a trend tool, a trend indicator, which is mostly widely available on most platforms, which is also another great tool for trend trading, which we're going to discuss later on as well. Now, in DMI, the main key thing is always what we call the ADX line, which I'm going to share later on. So ADX, once you identify the trend, it's important to understand, are we late in the stage of the trend? There's no point coming into the uptrend when the uptrend is showing you distortion. So one way to gauge the strength of the trend is to look at the ADX value. So as long as the ADX value is still above a certain value, it's telling you that the trend is still in place and there's strength to it. So now it's a good opportunity for you to ride. But I think importantly is that once a trend can be identified, is to make sure that is there strength. And once there's strength in the market, that's where we should capture the opportunity, so that we can identify through ADX. Now, last but not least, I think it's important to make sure that we have a way to manage your target profit and your stop loss level. And I think that's one of the ways I always utilize is to look at the ATR value, because that will give you an impression on where the market is slightly going to go. So ATR, in a way, is give you a range, and from there we are able to set your target profit and your stop loss accordingly. Now, just to show you a difference here, so Japanese candlesticks and Heikin-Ashi, Japanese candlesticks are more for trend reversal, and it's pretty much a common candlestick pattern that is widely used and widely adopted in across a lot of strategies. Now, Heikin-Ashi is slightly different. It's something that is newer, but again, it's based on the principle of Japanese candlesticks, which have the open high, low, and close. But Heiken Ashi is more emphasizing the middle of the bar, taking an average calculation of the bar. So therefore, in a sense that it can paint the picture of the trend in a clearer fashion. Now, Japan's candlesticks has 100 over patterns, so in that sense, it is, to really master candlesticks, Japan's candlesticks is not an easy task because you have to understand, you have to see across many different patterns. But Heiken Ashi, there's only 3 distinct patterns you need to know, and because of that, it's easy, and a lot of people tend to use it to identify trends. Now, Japan's candlesticks is to look at price gaps. So Heiken Ashi, you look at a candle formation, they usually represent the gaps or the price gaps by the color of the bar. So now if you're using gap strategy, you can't really see anything if you use Heiken Ashi. So you want to look at gaps, gaps in prices, you have to convert the Heiken Ashi or revert back Heiken Ashi to Japanese candlesticks. So these are the 3 distinct patterns. Always understand the color green. To some platforms may show you a white color bar. Usually tells you the market is bullish, and if it's a red, usually tells you it's a bearish bar, or if it's a black color bar, usually tells you it's a bearish bar. So as long color identification is one way to look at trends in the market for Heiken Ashi. Now, importantly is that the 3 distinct patterns. Once you see a green Heiken Ashi bar with only one upper wick, usually tells you that this upward momentum is very strong. So if you are new, if you look at the chart, you start to see green candle bars forming, and the upper wick is forming. That tells you that this bullish trend is just starting. And if the candle bar, the body of the bar is white, it's telling you that this upside momentum is going to be strong. Vice versa, you start to see a red body bar is telling you that this downward momentum is going to be very strong. So red and green is just telling you whether the trend of the market persists. Now, if you see green candles with both upper and lower wicks, or even red candles with upper and lower wicks, is telling you that this this trend momentum is start to lose its momentum. So if you start to see series of green bars with only upper wick, and suddenly there's appearance of a green bar by upper and lower wick, probably is this telling you that this green bar is probably going to get weaker, or rather this uptrend is probably going to be exhausted. So you can further get confirmation from the EDX value, which is going to show you later. So by having this, you're able to identify whether this trend can still continue or not. So understand the different distinct patterns of the Heiken Ashi can help you to understand whether the trend can still persist. Now, the last pattern that you need to realize and recognize is that once you start to see big wicks, or the body of the candles are very small, like this third picture here, or almost like a dodgy style. This usually comes when the markets, after a trend season or trend period, the market tends to consolidate, and that's where the market moves sideways. During this period, a lot of formation of dodgy candles or dodgy style candles is telling you that pretty much the market is moving sideways, and during this time, if you try to use trend trading strategies, it will not work because the market is moving sideways. So it's important for us to adapt. If the markets are moving sideways, we shouldn't be in the market. That's where we need to adapt to where the market is behaving. So Heiken Ashi is a great tool for you to look at trends or identify trends in the market during a particular period. So just to give you a context, this is the dynamics of it. So red body candle bars, very white red body candle bars is telling you that this market is on a strong downward trend. So once the body gets smaller and smaller, it's just telling you that this downtrend is exhausted. And when you start to see appearance of a upper and lower wick on the red candle bar, it's just telling you that this downtrend is exhausted. It's probably going to be moving sideways. And true enough, once you start to see like dodgy types or small body candles, it's just telling you the market is really going to be range. And if you want to try trend trading during this time, you can get a lot of results. So it's important for us to identify looking at the color of the candle bars and the position of the wick. So I'm not going to go too much on introduction on Heiken Ashi. It's just basically a calculation of the average bar in the Japanese candlesticks. So if you are someone that likes programming, you can do coding, you can automate a certain strategy, then obviously Heiken Ashi is quite useful in that sense because it's based on a certain calculation and a certain formula based on the Japanese candlesticks. So Japanese candlesticks, you want to apply so-called automation is not easy because it's all about distinct patterns you need to recognize. In some ways you can do it because even that nowadays the computing power and technology is getting more advanced. So definitely I think that's a bit, you can even automate pattern recognition on Japanese candlesticks. But Heiken Ashi is a very simple mechanization that you want to do if you want to automate the strategy using Heiken Ashi bars, because it's just based on a fixed formula that is derived from the Japanese candlesticks, and with that it's easy if you are looking to automate or you are into automation on the specific trading strategy and styles. Now, why is it Heiken Ashi is popular? Like I mentioned, because of the colors, it's easier to identify, and if you compare to Japan's candlesticks, Heiken Ashi helps you to stay longer in a particular trend. And if you just judge by the size of the body bar, you are able to understand whether the trend can still continue or is losing momentum. So with that, intuitively, it's actually easier for you to able to identify whether the trend can still continue or not. So these are major difference. So here you can see two charts on the same product, same period. Again, the major difference is the type of candles. So here what we have is the normal Japanese candlestick. So you notice that you have long red bars, which is also you can see that in Heiken Ashi. But this is where it gets tricky. Now, when you start to see a bit of retracement in the downtrend, you start to see, oh, is this going to be a turn in the downtrend cycle? It may not be, but as long as Heiken Ashi is still showing you red, this particular market is still a downtrend market. So, but if you're just using Japan's candlesticks, this is where you get confused. You see a series of red, the next series you see a green, probably thinking, hey, the market probably, this downtrend market is going to be exhausted. So, having a Heiken Ashi candles can help you stay longer in the trend. The only downside, or rather, I'll say it's not really a disadvantage, but if you are using a gap analysis, whether or not if you're trying to understand whether this particular price gap can be fulfilled, you really can't use Heiken Ashi, because Heiken Ashi will represent the gap by the body of the candle. So in that sense, you are using gap analysis, you can't use these candlesticks. So that's where the major difference between these two. Now, what determines a trend in the chart? Like I mentioned earlier, visually you can look at a chart. If it's showing you higher highs and higher lows, normally it's an uptrend market, because the highs are getting higher, the lows are also getting higher. So normally in the uptrend market, you start to see this kind of behavior. If you measure the highs and lows for price movement, if those highs and lows are getting higher, it's telling you it's an uptrend market. Downtrend is the reverse. If the highs are getting lower and the lows are also getting even lower, it's telling you that this market is downtrend. So it's clearly, you can use the high and lows to measure whether the market is downtrend or uptrend visually. Then obviously if the highs and lows are pretty much equal, it's telling you that this is sideways or range market for the particular period. Now, another way to determine trend is to look at moving averages. So you can plot certain moving averages period, like let's say 20 period and with a 50 period moving average. So as long as if you have a crossover whereby the shorter term or shorter period moving average crosses above the longer term 50 period moving average, is telling you that, oh look, this market is priced to go on a higher basis. Or even in fact, if you just look at candles observation, as long as the price or the candles are above the moving averages, it's telling you that look, this market is going on an uptrend basis. So there's a lot of measurements that you can take. Even moving averages can also show you trend in the market, and vice versa. If you see prices or candles staying below the moving averages, telling you that this market is on the downtrend. So understanding where the prices positions are or the candles with regards or with relation to the moving averages can also give you a guidance on where the market is trending. And also looking at, when you use moving average, you always look at crossovers as well. So you have a shorter term, you have a longer term, you pair that together, look at crossovers, and that could be a signal for you as well. Now, third, you can also look at trends or identify trends in the market by looking at trend lines and channels. So trend lines is where you try to match the highs and another period high and lows and another period low, as long as you can form a channel. You can see a channel between a trend line and it's sloping upwards. It's an upward sloping trend line. It's just telling you that, look, this market is actually on an uptrend basis. And vice versa, if it's a downward sloping trend line or descending trend line, it's just telling you that this market is actually on a downtrend basis. If it's just a flat, it's just like both lines are flat, the highs and lows are flat. This is just telling you it's a range market, and therefore, in the range market, you need to apply a different strategy altogether. So just to give an example, what do you think about this particular trend that's on the soybean oil contracts, which is listed on the CME exchange? So you can see that The current candles, we start to see a series of strong green candles and followed by a series of red candles. Uh, Again, then the market try to recover. Now we start to see a series of red and green. So it's just telling you that soybean oil on a daily basis is showing you that the market is heading to nowhere. But again, you look at the immediate trend or short-term trend that's in place for the past 2 months. The market, both the prices are staying above both the moving averages line. So it's telling you that despite the current trend in the market, the soybean oil is not going anywhere, but on a medium perspective or medium period perspective, the short soybean oil market is actually heading on an uptrend. Because as long as prices are holding well above the moving averages, it's telling you that this market is actually on an uptrend basis. Now, gold is the one that's very interesting. You can see that, you know, one thing to take note of is that moving averages is not only to tell you where the direction of the trend of the market is, it's also giving you a dynamic support and resistance point for your market as well. So you can clearly see that gold is actually been supporting well above the 50 period EMA. These are based on the daily chart. Again, there's a couple of instances where it tested to try to break below a 50 period EMA, but it's still holding well. And again, this is a very clear uptrend. The highs are getting higher, the lows are also getting higher. So it's telling you that this is an uptrend channel. Gold market is definitely on the bullish phase of the market. Now, S&P 500, this is very interesting. During the start of early March, you can start to see there's a breakdown, and it's a massive breakdown with volume. Now, again, if you just look at volume comparison, whenever you have a high volume and the market starts to go a certain direction, normally it tells you the market will start to trend. So here you can see there's definitely a breakdown on, I think this is a 50 period EMA, and eventually even break down the 200 period EMA. So technically the market is on a technical downside, and true enough, I think it stayed there, and until the liberation of the Trump day on early April, and when he announced there should be a 90-day truce on the tariff impact, that's where you start to see market recover. And right now you can see S&P 500 on a medium perspective is actually still an uptrend. It's trying to recover the loss that's actually incurred, especially during the beginning of April, beginning of March to the end of April. So I think you can clearly see S&P 500 is trying to make a recovery. But right now, I think market is actually moving on a sideways range as well. Despite that, the market is still pretty much on the bullish trend because the prices are hovering well above the 50 and 200 period EMA. Now, this is FCPO. You can see that pretty much you can see a downtrend channel. So as long as you see the highs are getting lower, the lows are also getting lower. Technically, this market is on the downtrend basis. Now, prices are staying well below the 50 and 200 period EMA. So it's telling you that CPO market is actually quite bearish. Now, coupled with that, with the supply and demand is coming to picture, we are now in a season where prices tend to be weaker because of high supply. So this is where you can see that prices are definitely on the weaker side. So if you're trying to find when the market is downtrend, always remember find position to short rather than long. So if there's any retracement or technical retracement in terms of prices, that will be a good position for you to short the market, especially for the crude oil, the CPO market space. Now, the reason I also introduced moving averages as part of the trend tool is that having Heiken actually alone is not a very good strategy because the candles can change. Sometimes you need an overlapping signals or overlapping tool that help you to give a better decision on whether the market is going a certain way. So I think one of the great tools to have along with Heiken actually is to compare that with moving averages. So moving averages pretty much is just a line that is moving out the price data. There's many various type of moving averages. I think the most common one is a simple moving average, which I think a lot of people use. Now another more common one, keep in mind, moving averages is technically a lagging indicator. That means you usually take past prices. So simple moving averages may not envelop the price movement that closely because it gives equal weight to all the past data, as compared to exponential moving average actually gives more weight for the recent price data. So if you are someone that wants to look at where the movement of prices is based on the moving average, EMA is a better choice. Exponential will give you a better better precision because it actually envelopes or move according to the price changes much faster manner compared to the simple moving average. So just to use moving average is actually very simple. As long as prices are above the moving averages, this is telling you the market is actually uptrend. If prices are below the moving averages, it's telling you the market is on the downtrend. And usually moving averages can also act as a support resistance. And as I showed to you in a couple of slides back, as long as prices are above, it doesn't break down a certain moving average line. It's telling the market is holding well. And the moment it breaks, you need to get the few confirmation signals in the subsequent candles. If the subsequent candles is below the moving averages, it starts to break below the moving averages, and moving averages starts to turn, it's telling you that this market is getting bigger or is breaking a major support. So if it's an uptrend coming down, in fact maybe there's a chance that the market is going to hit downtrend basis. So the moving averages is in a way is not only giving you the crossover signals, but it's also giving you a dynamic support and resistance to a particular price level. So it's in a way it's useful if you are looking at not only in trends in the market, you also want to understand where the support of prices is likely to be. Moving averages can give you that kind of indication. So just to give you some examples here. So you look at FCPO market, you can clearly see that this is basically 20. This is 9 period and 20 period EMA. So 9 period is a shorter term. The 20 period is actually the longer term. So whenever the shorter term crosses below, technically it's a bearish crossover, and you get the confirmation by looking at the candle of the Heiken Ashi. And the Heiken Ashi in this series, you get a series of red candles, strong red candles with white bodies. Is giving a strong signal that this market is actually quite bearish. Vice versa, here you start to see a bullish crossover, the shorter term crosses above, and you can see strong green candles, and the body of the green candles are actually quite white. So it's telling you that this is actually a bullish crossover in the market. So these are good entry strategies for you to take a long position. Now, so moving averages is not only acting as a crossover, it also can act as a support and resistance. So here you can have a classic example. If there's no breakthrough, if the candles are still being weighed down by the lines, if there's no one candle that break through both the 9 and 20 period EMAs, it's just telling you that the market is still on a downtrend. Now, as soon as when the candle starts to go above both the lines, and you start to see green Heiken Ashi bars and the crossover on the moving averages, that usually technically tells you that the market is actually going on an uptrend basis. So importantly to identify is moving averages are not only useful for crossover strategies, but it's also useful for identifying the level of support and resistance in terms of prices. Now, this is just to show a classic example of S&P 500. Again, here is once you start to see a green color body bars, strong body bars, it's just telling you that this market is poised on uptrend. But the how volatile nature can S&P 500 be is that on one session it can go up, the next session it can obviously come down and reverse any of the gains of the day. So S&P 500 in certain ways or certain period it can be very volatile. So that's where it's important for you to measure your target profit and stop loss accordingly. So in case the market will go against you, you get stop out quite immediate and plan for the next trade. So here you have a classic long position entry because you can start to see green Heiken Ashi bars and it's a bullish crossover on your moving averages, and that's usually a signal for you to take a long position. Now, the third trend indicator I want to introduce to you, which is DMI. Now, in DMI, there's actually three particular lines that's important to take note. One is obviously the positive directional indicator or positive DI. The other one is negative directional indicator, negative DI. So this positive is basically to measure upward momentum, and minus DI is showing you downward momentum, and EDX usually measures the strength of the trend regardless of the direction. So importantly, whenever you look at DMI indicator, normally we look at the EDX, which is more crucial because EDX, once you identify the trend, whether it's uptrend or downtrend, it's important for you to look at whether whether the trend is still strong. There's no point to enter the trend when it's getting bigger, when EDX value is coming down. So importantly is that once you identify the trend, second thing is important to gauge the strength of the trend. So classic example, if you're using DMI, crossovers is a classic strategy whereby you start to see positive momentum start to go above the negative momentum. It's just telling you the market is actually poised to go higher. Vice versa, if the negative momentum crosses below, it's just telling you that there's more downward pressure for the market. So having that in place. So of course, the greater the gap between these two, that means the ADX movement is going to be high. So it's telling you that whatever direction the market was moving, it's going to be having more momentum. Now ADX is actually it's a line based on the value. Anything that is above 25 is telling you that this market is very strong in terms of trend. ADX value that is below 20 or even the range of 20 to 25 below that is telling you that this trend, this particular trend in the market is getting bigger and it's going to be a range market. So just to give you some example, so this is looking at two lines, positive. Green line is actually the positive directional movement, and then red line is negative directional movement. So crossovers are simple. The moment you start to see the positive crosses above the negative, and can get pretty much the same signal as your bullish crossover here, whereby you start to see that the shorter term crosses above, and you start to see green Heiken Ashi bars is telling you that generally this is a positive momentum that's coming in place. So this market momentum is actually going to go higher. So vice versa, once you start to see the minus DI crosses the positive DI, technically this is a bearish crossover. So you can see that DMI crossovers and the moving average crossovers are actually very similar signals. So in a sense, they are actually overlapping each other. So you come to a choice whereby you can actually you don't need to look at DMI in terms of crossovers because you really have a moving average crossover, or you can choose either one. Having both sometimes can give you an overlapping signal. So it's a choice between how a trader will have to adapt the strategy accordingly to the market. So what we have here again, you have the same similar signals generated using the moving average crossover as well for the DMI crossovers. So what is important? Same goes. This is another example looking at gold. The DMI crossovers are giving you the similar signals like a bullish crossover or a moving average crossover. So you have overlapping signals between the DMI and the moving average crossover. But what is important is that in using DMI is actually the ADX line, which is the black line here. So this is based on the FCPO market. So what we have here is that you can see that positive DI actually crosses above the negative DI, which usually tells you that this is usually a bullish signal because the positive momentum is gaining strength. And you can see that there's a series of green Heiken Ashi bars. It's telling you the market is actually poised to go higher. What to take note is that this black line here is actually rising, and once the black line is rising or ADX line is rising, it's telling that this bullish trend is actually gaining momentum. In fact, this is probably the start of a bullish cycle. So you have once you start to see ADX rising in a particular trend in the market, normally it tells you that generally the trend is actually gaining strength. So here you can see a classic example of a downtrend market because you start to see red Heiken Ashi bars crosses or penetrate below the support line of the moving averages, and moving averages, the shorter term crosses below is technically a bearish crossover. You can see that ADX is rising. So ADX, where is the downtrend or uptrend market, as long as it's rising, it's telling you the trend of the particular market at that period is gaining strength. So if you are trend trading, you should look at ADX measurement as well as part of a way to enter and exit the market. So you can clearly see here, once ADX rises in the downtrend market, the downtrend momentum is actually quite strong until when it starts to go sideways. So this is telling you when ADX goes sideways, it's telling you pretty much this downtrend market is going to be exhausted soon. So this is where you need to be careful as well. So another thing to take note of regarding ADX is that as long as ADX falls below 25, generally that tells you that this market is heading no direction. So now if you are doing trend trading strategy, you should see ADX rises above the 25 level. Anything that's below 25, this is telling you the market is going sideways. So this is an example on FKI. Same principle. You start to see ADX going above. This downtrend is actually gaining strength. And when it starts to go flat, that's where if you're holding to short position, you should be out of the market because this downtrend is exhausted. So same goes for here. You can see the downtrend is gaining strength. ADX value is rising. So ADX is a very good measurement to measure the strength of the trend. So you should be in a market where, or you should be in a trend where there's momentum. There's no point to be in a trend where the momentum is weak or there's lack of strength in that particular trend. Now this is an example on the S&P 500. You can clearly see this is a very good entry for a short position because the candles, red Heiken Ashi candles are forming. there's a bearish crossover on moving averages, and you can see that ADX is actually rising quite rapidly. So this downtrend is actually gaining a lot of momentum. So right until here, where you start to see ADX becomes flat, you can probably see that this downtrend is probably exhausted. Importantly is that this moving averages, the candle doesn't break through, so this downtrend is actually pretty much still intact. If there's a forming of a green candle bar here, which is very wide body candle bar, technically this downtrend is actually not be I mean it's a change in trend. This downtrend probably is changing to an uptrend. But I think since that the candles are holding well, it doesn't really break the moving averages. It's just telling you that this downtrend is still pretty much intact. So in that sense, moving averages also gives you a guide on where the level of resistance and support is when it comes to prices. Okay, so you can clearly see, right now, I think this just taken a few days back. FCPO market is still pretty much on a sideways or pretty much more on a downtrend market. As long as, because you can see the highs are actually getting lower, the lows are also getting lower. So it's telling you that we are down on the downward sloping channel for the FCPO market. But having said that, ADX is still below 25. It's just telling you there's pretty much no direction in the market. So if you want to look at where the next trend of the market is, watch out on where the ADX value starts to rise for the FCPO market. Now, the last bit when it comes to forming a structure in terms of trading style is to make sure that you must have a way to measure your profit level and also measure your loss level. So one of the ways is to look at average true range, which is another indicator which measures the actual range of the particular period. So it's basically calculated on the greatest of the current high and low, or even the current high comparing the previous close, and the current low comparing the previous close. So it gives you the actual range of the particular period. So obviously when markets are not volatile, very small range, your ATR value is going to be small. But when the markets are more volatile, moving quite heavily or ranging quite quite in a big range, then your ATR value is going to go up. So normally high ATR usually stands for high volatility. And one good rule of thumb is that when ATR starts to rise or volatility of the market starts to go up, usually it tells you normally it goes up in the trendy market. So one of the ways or another ways to look at whether the trend of the market is forming is to also look at ATR value. If the ATR value is going high and higher, it's also quite one good indication that the market is getting more volatile and it's trending to a certain direction. When you have a low ATR, it's just telling you that the market there's no direction, or rather the market is not sure whether it's going up or down. So therefore, the ATR or the range is actually quite flat. So you can see here, this is a good example. We start to see last year, especially the end of last year, we start to see ATR values start to rise. So when ATR values start to rise, you can see there's actually trend appearing in the market. So last year, the trend, end of last year, the trend of S&P market has actually been a bullish trend. Then when it comes to early part of this year, again, you can see ATR value is actually quite high. The market is actually trending lower. Now, right now, the ATR value for S&P market is actually coming down. So in a way, it's also indicating to you the market is actually heading sideways and there's no direction, there's no clear direction yet for the market. Now, this is actually for gold market. Gold is a very classic example. ATR value starts to rise in early April, which is coincide with the Liberation Day in US on Trump tariff. You can see that actually gold picks up substantially in terms of ATR. So that usually also tells you that usually be a start of a trend in the market. Now, the interesting part in S&P 500 when it comes to ATR value is that every time when ATR starts to increase, normally it means that the market is very volatile and usually it be a panic in the market. So every time there's a downtrend or a technical retracement in S&P 500, usually associated with high ATR value. So that's one indication you can use ATR for. Same goes for FKLI. If you notice that this big spike down in FKLI prices is usually associated with high ATR value as well, which is very similar behavior in S&P 500. So whenever you start to see, especially you're trading indices futures, you see high ATR value, that usually tells you that the market is going to face a bit of panic. Therefore, the range is getting wider, and that's where usually be a start of a downtrend or it's a technical retracement in a particular trend. Now, so coming to that, if you compound all together, this is where you can do a proper setup. So one of the ways to identify trading entries is to look at Heiken entry bars. If the Heiken entry bars is green and there's a bullish crossover, technically this is the uptrend. And normally if you start to see the ADX starts to rise above 25, usually that means that this uptrend is actually just started. And once you have that, you have an ATR value of 12.5. Technically you can actually set your profit target and stop loss level accordingly. So how we do that is that once we have a long entry, that's triggered by the green Aiken entry bars, you have an ATR value of 12.5, and you work on a risk to reward ratio of 1 to 2. So you are looking at technically 25 points of profit, 12.5 points or 1 ATR value for the stop loss. So it's important for us to always must have a way to get yourself out. So in this way, or in this example, we are using the ATR value to get ourselves out, just in case the market goes against us. Now another example, this is basically on the gold market as well. This is a classic short position or short entry position because of the red Heiken entry bars formation and the bearish crossover moving averages. Same goes with DMI crossovers are actually bearish because of negative DI causes both the positive DI. But what's important to take note is that ADX is actually rising, so it's telling you that this downward momentum may actually have a bit more strength. So again, the ATR value is also rising, which is 12.5 points as well. So this is actually a short entry, and again you work on a risk to reward ratio of 1 to 2, which means that you willing to risk 1 ATR for 2 ATR as a reward profit or reward ratio. Now risk to reward ratio is actually very subjective. Again, there's a lot of factors that need to be calculated to determine the right risk and reward ratio for an individual. So keep in mind, risk and reward ratio can vary accordingly, but always have in mind ways that to measure yourself out in case the market goes against you. Now, this is an example on SCQ market. This is interesting because you look at the highs of the period, the highs of the candles are actually getting lower. Even the lows of the candles are also getting lower. So technically, this is a downtrend market for the SCQ at this point in time. So you can see that negative DI is actually causes both, so it's a bearish crossover and DMI. What's interesting is that the ADX is rising, so it's telling you that this potential downtrend is actually coming quite strongly, and ATR is actually 30 points. So again, simple concept, ATR to measure your profit target and stop loss. Always look on a 1 to 2 ratio as a start. You can obviously adjust it according to your comfortable level. So you're willing to risk 1 ATR. Now this is an example on S&P. Now this is also one of very good entries because once you have a strong bar like this and it's breaking above, this is actually a range before that. Normally it just tells you the trend is starting. And ATR, once ATR starts to rise together with the ADX value, it's telling you that this uptrend momentum is actually gaining strength. So this is a good example of entry on the S&P 500. So this is what happens after next. Obviously, if you have set your ATR targets accordingly, you'll probably be out by VDD or the next candle. Now, if you just look at overall trend, there's a lot of debate going. There's a lot of question. Why not you can hold a particular position right until probably the ADX has peaked, which is about here. You can do that, but a plan is a plan. If you have adjusted your plan to follow the ratio of looking at ATR as a way to get your target and to get your stop loss level, you should stick to it. Until when the markets are not working in your favor, then you should adapt your structure or trading plan accordingly. Now, so that's pretty much on how you create a structure or trading plan. Just to recap, I think it's importantly for us to identify trend by looking at Heiken Ashi candles. And secondly, you can always pair that with moving averages or DMI crossovers. Keep in mind, both of these tools are giving overlapping signals. So you can either choose one, you can use both, but in a sense that sometimes you can get overlapping signals. Now, importantly, the DMI indicators is actually gives you the benefit of the ADX value, which is very important for us to gauge the strength of the trend. Once you identify where the trend is heading, the market trend is heading, I think the next key thing is that whether is the strength still persistent. If the strength is still not persistent, there's no point jumping into a particular trend in the market. Last but not least, always make sure you have a way to measure your risk and reward accordingly. Importantly is the risk. A lot of people always miss this part. People always think about the reward but never about the risk. So one of the ways to measure your risk is to look at your ATR values. Okay, so just looking at where technical outlook is, you can see the S&P 500 is actually going sideways for now. The fact that ATR is decreasing and ADX value is below 25, this uptrend, this medium-term uptrend that's happened in the past couple of weeks, is probably going to be exhausted in the next couple of days. So it's crucial to watch whether would there be a technical retracement in comes to S&P 500 or will it continue? It's quite difficult to continue because ADX is still below 25. The moment it breaks 25, there's a possible change in trend or possible trend in place. Now, SCPO, despite today's performance is pretty much bearish phase of the SCPO market, is still sitting well on a very tight range. And the prices are still hovering above 3,008 and hovering below the 4,000. So technically, SCPO is actually in the range market now. Daily daily ADX is also pointing to below 25. It's just telling you the market is actually heading sideways for now. Even ATR value is actually decreasing. So this is where I mean, this is what I meant by looking at ATRs for if you're trading in indices futures. So a lot of times when you start to see a spike in ATR value, normally associated with usually a market panic, especially for the indices futures. So be careful whenever you start to see this rising ATR. Normally it does indicate to you trend. As for now, I think FTLI is still on pretty much on a bearish mode, or in fact ADX is just pointing to you there's no clear trend in FTLI. In fact, it's still pretty much in a trend, in a trend or in a range per se. Now, this goal is interesting. Despite the uptrend I'm seeing, the EDX actually fallen below 25. So it's just telling the market is heading sideways. But what is important to take note is that as long as this red line doesn't crosses or do a crossover with the positive DI, it's just telling you that this upward strength is losing momentum, but it doesn't tell you that whether there's a possible change in trend. But the moment when you start to see the minus DI, the red line crosses above the green line, there's usually does indicate to you that there's a possible change, or temporary or short-term change in the trend for the gold market. Normally, when you start to see a strong rally especially in the particular market, they're bound to have a breather. So I think gold is actually quite timely for that. And if you believe in, I mean, the narrative for gold is still very optimistic. So I think the next potential technical retracement for the gold market will be a good setup for an upward or for the upward next movement, which can propel gold prices into higher territory. Now, silver is getting very interesting because you can see that there's a slight uptick movement in your ADX. It's just trying to tell you that this silver movement could probably have some strength, and I think it's worth to pay attention to silver market as well. As long as this ADX starts to rise, it's just telling you that this potential uptrend is probably going to have a bit more legs to go. And ETR value is also rising, so it's telling you that this upward momentum is probably going to gain some strength in the coming days. So I covered a lot in terms of looking at how to navigate different markets. I think importantly is that we must always understand what kind of opportunities that we can take. Now I think with CME Exchange, and it's being offered by Apex Futures as well, you can notice that there's a lot of contracts that you can probably leverage on. I think it's a good start. If you are new to trading space, it's a good start to look at contracts that are small, and CME offers a micro contract which is small in margins as a good way to get a touch or get a feeling of how those market works. So CME have a comprehensive suite of micros products. Start off with micro indices like your micro Russell, micro E-mini, S&P, or even micro Dow Jones. So these contracts are very small. Probably the margins are between 1,000 or 1,500 US dollar. I don't have the latest margin, so if you want to get the latest margin, you can obviously speak to Apex representative, Deco Silver, or even Michael Paladin. So all this gives you, once you have a small contracts, it gives you more opportunities. So those days you want to trade on this type of markets, the margins that are required is actually quite heavy. Now with smaller contracts, smaller margin requirements, it actually allow more users to actually experience how the market works by just leveraging on a smaller contract. So I just give you a contract specification for micro gold. So every dollar movement is only about $10. So the big contract, every dollar movement is 100 US. So it's a very big contract. So when you have a micro contract, it's actually making things easier. But keep in mind, margins can change. This may not be the latest margin. Always get the latest margin from Apex. They probably can give you the latest margin as of date. So not just to draw example from the margins for micro gold, you can see that one contract is only about 1,500 US dollars just to trade on the gold contract. Those days, you want to trade the big contract, that would require even much bigger margin requirement. So therefore, it actually hinder a lot of participation in the market. But I think with introduction of micros, it's actually making things easier. Now, besides all these contracts are new, and whenever there's a new contract, there's always stands a risk whether there's participation in the market. So if you look at micro gold futures, you can see that participation across the board is actually quite active. And with now gold being a very major news-driven, very highly sought after safe haven asset, you can see the interest actually getting higher and higher. So there's no issue on liquidity. If you just look at how micro gold futures, the average daily volume is between the range of 500 to 800,000 lots per day. So that's a very liquid market. Now, what's interesting to take note is that the ETF for gold markets actually been rising quite substantially back in early April. Obviously, in this couple of days, the ETF rate actually starts to decline. But having said that, the range per day, this is based on ATR value. You're looking at about between 60 to $80 range, which is quite a huge range. So if you want volatility in the market, gold is actually a good place to start. And the micro gold contract is actually a very good place to start because of the size of the contract. So, if you are thinking to try to understand or try to look at volatility in the market, the gold contract could be a very good market to start off with. So I'm just going to end here with a couple of quotes. Normally I'll just give you some insights. Whatever I mentioned today is very technical in the sense that will give you a whole perspective on how to combine fundamentals and technicals and give you a comprehensive way of navigating the market. But importantly, I think as I mentioned in the previous webinar session, the key thing that a lot of people miss is that never put a lot. Um, those who are started new in the industry, they don't put much emphasis on looking at things on a more psychological basis. Now, in trading, it's all about yourself. So that's what Alexander Elder, a great trader, always says that your biggest enemy is always yourself because ultimately the one that makes the decision is you. There's no one else. There's no one that's forcing you to make a decision. You yourself that make a decision. So there's always to battle the market is always a battle of yourself. So trading is not so much about how the structure, whether it's fundamental or technical, but rather I think there's a lot of psychology that's being involved here. So importantly, if you have the right mind frame, the right mindset, then that will really be something that you really need to inculcate, and that will make your trading journey a bit easier. I think the second quote which I want to share to you about what trading is all about and trading success, how do we accomplish trading success is pretty much down to discipline. So I think if you don't, when I first started this journey, my mentor always tell me this, without discipline, it's very difficult. And discipline is in terms of whether it's following a trading plan, whether it's making a decision that is very in a disciplined fashion. So when you reach your target loss, you should be out. When you reach your target profit, you should be taking profit. So discipline in that sense, or even discipline in terms of your trading routines. I think one of the key characteristics or key traits of a successful trader is always having a strict discipline regime that is enable a trader to always adhere to his or her own principle. So I think that's one of the two key traits or key quotes I want to just share with the audience tonight. So I'm just going to leave it to you here, and I'm just going to hand it over to Suning. If you have any questions from the audience, which I can address.
All right, thank you, David. Thanks for your insightful sharing, which you bring us from the local markets, FKI, FCPO, and to the foreign markets, the gold, S&P, and also the related foreign product, and also for for your information, all the audience, Apex are offering the derivative tradings for local market Bursa Malaysia, and also we do offer the products from CME exchanges. Yeah. So now we are opening to the floor for Q&A session. So if you have questions, feel free to drop them in the chat box, and let's take these opportunities to learn even more. Okay, let's see. Okay. Okay. All right, we have first questions. Yeah, David, the first questions. Okay, based on the sharings and ADX indicator, the value, if above 25 typically indicates the trend is present. So sometimes it will have false signal. So it is if I suffer 3 consecutive losses, for example. So could you please share what is the specific conditions or the setup that should be met uh, in order to increase the success rate when entering the trade based on ADX?
Okay, that's a good question. Now I think it's a whole package. You can't just solely rely on EPS as a first signal. That's a lot of variable. You see the position of candles, the length of the Heikin-Ashi body bars. I mean, you talk about priority. I mean, obviously, Heikin-Ashi and moving averages or even the DMI crossovers are priority. ADX is just telling you the strength of the trend. Sometimes, you can see white body bars, but ADX is not rising. It's within the range of below 25. But the uptrend, the downtrend is actually quite strong because of the Heikin-Ashi body bar. So this is where there's a lot of discretion have to be involved. So I would say this, when you suffer 3 consecutive losses based on the signal of ADX, I think is the variable, the dynamic. I mean, the ADX variable on that particular market may no longer be useful. So it's time, whether the market is actually moving to a sideways market, it actually nullify the effect of ADX. That could be a reason, but once you have 3 consecutive signals, usually it tells you that particular structure may not be working, and it's time for you to adapt to certain ways or certain strategy altogether. So that's usually my advice. I think, but again, it's part of a whole comprehensive package. You can't just look at ADX from there to manage the signal. There's always other particular signals or indicators involved as well. Basically, look at you can actually moving averages, or even looking at the DMI crossovers. So ADX is just part of it by just looking at strength of the particular trend. Trend direction is still very key, and how we do that is looking at the Heikin Ashi moving average crossovers.
All right. So the advice is we have to combine with other indicators as well, right?
Correct.
And then continue with the questions regarding ADX indicators. So is this applied to outright only or spread only or both markets? So could you please share with us further?
Okay. Now, spread. I have to put a disclaimer to that question. If you talk about spread for CPO, ADX is quite a good way because spread tends to trend longer and trend in certain direction in a longer period compared to outright. So, like for example, SCPO calendar spread. You can use what I mentioned earlier as a way to navigate this CPO calendar spread. Now, if you do it in, let's say, grains market, whether it's soybean calendar spread, soybean oil calendar spread, it's a whole different dynamics. Then because sometimes this spread doesn't show you any trend tendencies. The spread can stay within a certain range for a long period of time because the nature of the particular market itself is just like that. Indices calendar spread is also totally different. Sometimes it can stay a range. So I would say, just to answer the question, it really depends on the market that you are trading. So applying ADX tool, especially for calendar spread on CPO market, when calendar spread in CPO market can be quite trendy, is a useful strategy. But in other markets like grains, may not be that useful because the range of a calendar spread for those markets can stay in a particular range for quite a long period of time.
Okay. Thank you, David. So we have new questions coming in. Okay, one of it. what if I want to trade at consolidations? So since the market most of the time are moving in consolidations mode, and is there a recommended strategy for consolidations?
Now, if the markets are consolidating or from a trend is going to a sideways pattern, I think that's more useful to look at I would say more to range trading. That's where you look at range trading tool like RSI or MACD, those type of range trading tools. And you can't really look at Hidden and Chain one. So it's really important to identify when the market is trending and when the market is going sideways. So in the consolidation phase, obviously you can use more range trading strategies like looking at RSI or MACD's value as a way to determine the market direction or entries.
Okay. Okay, thank you, David. Okay, I think I got a question that's
Sure,
quite related with trading psychology. Maybe you
sure.
can share a little bit on this. Okay, is there a time or what market conditions you would choose not to trade at all based on your some personal experience?
Okay, I would say this: if you are trading non-Malaysia markets, especially CME markets, then obviously active hours are like right now. Where it's usually non-Asian friendly. After 9:30 or 10 p.m.,
Yes,
you can stay until 1 a.m. And if you trade in both markets, it's never easy. If you want to do local markets, Bursa, and you do a CME US product, this is not easy because the time where it's active is completely different. And to do both markets, is unless you do automation, that's a totally different level. If you are making decisions, human discretion, it's not easy. You need that stamina. So I would say this, choose a product where you're comfortable with. If you want to start off with local market where you're comfortable with, you're more confident in that sense, then start with that market. Then once you have a bit more confidence, you want to try the US market, then go for the US market. And once you establish a particular structure for that market, then stick with it. But be comfortable with the market that you're most comfortable with. And trust me, you have to make a decision. Ultimately, whether you want to trade the local market or the US market, you can't do both because the hours are just not friendly, especially the US market. And they are
correct.
non-Asian friendly. So
Yes,
unless you are very good, you have strong stamina, you can do both markets, then so be it. But so far, that's not a good advice because we're still human. We need our
yes,
rest.
yes. Mentally, we have to rest.
All right.
Okay, so now we open for the last questions for these webinar sessions, and we have a question from a spread traders. Okay, so sometimes he see a outright contract like he's mentioning about the FCPO contract. So the third month contracts is moving up, but the spread of the third month and fourth month is moving different directions. So the audience would like to know the relationship between outright and spread
Okay.
in the simple
Um,
way.
okay, sure. So you must understand the principle of outright calendar spread. So in outright, it's purely you're dealing with one particular contract, whether buy or sell, it's one particular contract. When you're doing a calendar spread, you're buying you're buying one contract and selling another different contract. So you're doing a simultaneous transaction, which is offsetting each other. Because ultimately, when you are involved in a calendar spread, what you are dealing with is actually the price difference between two different contract months. That's your bill. So not necessarily when, let's say, for example, you're buying August and selling September, which is you're buying August, September calendar month spread, and you are buying a August outright contract. August outright contract can move up, but the August, September calendar spread can move down. That's because the simple reason is when you're doing a spread, it's always looking at the differential between the August and the September contract months. Not necessarily when contract moves up, the August September calendar spread must move up. It's always talking about the differential between the August and September. Now, the movement of this particular market, there's a lot of variable to it because you're looking at two different contract months altogether. So there's variable that you have to take into a position. But important to take note is that not necessarily when the outright move for a particular calendar, the calendar spread itself must move in that direction. First, keep in mind calendar evolve in other contract months, which may have a different offsetting move again your outright position. So That's where if you are new to calendar or spread trading per se, you need to understand these differences.
Okay. Uh, Alright, so I think that's all for the questions, and thank you for all the great questions. So we hope the sharing provided even more clarify and value for your trading journeys. And so thank you, David. And so before we
Sure.
end, please allow me to do some quick reminders. Let me open my slide. Yeah. Okay. Okay. Yep. Just want to remind that in this Apex Derivative Trading Challenge, you're not alone, and we've prepared apprentice support for you. So the first one is to join the exclusive trader community, the Discord, and some additional education material you can find on my Bursa website. So here's the Discord channel. Okay. Alright, if you have missed out our previous webinar session and you would like to learn, you can go to our YouTube's channel. Either you can scan this code and you can replace the webinar. Furthermore, there's a one-on-one coaching sessions for you if you participate in this trading challenge for personal guidance. So this is by appointment only. Okay, now let's check out our updated leaderboards as of yesterday closing. So are you in the list? If you're not on the leaderboard yet, no worries. We are still waiting for you to jump on the trends. There's still time for catch up. Remember that our registration is open until 16th of June and there's still time for catch up. So keep pushing and trading smart. So here is our contact number, the Apex Derivative Trading Desk contact number and our support hour. So you can print screen here. All right, and just like that, we are come to the end of the day 6 of our Apex Derivative Trading Challenge webinar series. So it's been a great journey learning and growing together over the past few sessions. And a big thank you once again to Mr. David Ng for his insightful sessions sharing today.
Sure.
If you have
Thank you.
further inquiry or follow-ups, feel free to contact us. And thank you all for being the part of this journey. We wish you the best in your trading challenge and see you at the top. Thank you everyone and good night.
Good night. Thank you.
Thanks.